Bismillahirrahmanirrahim. Assalamu alaikum. Very good afternoon to everybody. We've been given 10 to 15 minutes. I hope to come in within that time. I'd like to commend the organisers for the logic flow from session to session. And I hope that what I've got to say follows on from the last session and maybe ties back to some of the other sessions that we've had. The topic around capital markets and alternative business models for financial institutions, and I've subtitled it about some catalysts for economic development and sustainability. In keeping with some of the comments made in the previous session, I'm not entirely convinced that existing financial institutions are the right vehicle for carrying this forward, but I'll discuss that as we go through. Many years ago, when I got first introduced to Islamic finance, and I was asked questions because I was a little bit unusual, because I was probably the only white guy at that time who got some knowledge of it, and they used to say, "What's it about?" And I used to stumble and struggle about trying to explain riba, which was an extremely bad point to start at. And after 3 or 4 years of stumbling through trying to explain riba and taking about 3 hours and then tying myself up in knots and everybody else, I came up with a little bit of a catchphrase which goes something like this: that Islamic finance is about the effective and efficient mobilization of capital for the benefit of the real economy. And I still hold true to that, or I still believe that that is actually the truth. And therefore, in the light of this discussion, I want to focus on the aspect of financial inclusion, which is part of the equation. It's not everything, which I think came out of the last panel discussion, that financial inclusion is not the only thing, but I wanted to focus particularly on financial inclusion for SMEs. And as a former banker, I can say with some honesty and hand on heart, we certainly didn't consider anything on microfinance at the bank, and we were extremely nervous about anything on SMEs. And when I ran the first bank, Islamic Bank, I ran 8 years ago, I remember talking to the chairman of that bank in some detail about Mudaraba and Musharaka models, and he saw some sort of future in it in the sense of investment banking, but he didn't really sort of grasp the issues about the risk-taking portion that the bank had to take. And I remember being at one quarterly strategic business review meeting, which we used to have, and where we all had to stand to attention. And I was unable to convince the chairman at that time about the risk profile of the bank being really the opposite of what a conventional bank looked like in terms of the assets and liability management, and having a fixed rate on one side as opposed to the other side in a conventional bank. And as a result, he shut down all of my automotive financing business, which actually at that time, when I'd taken on the bank, was 40% of my portfolio. So therefore, there's always been a struggle to convince the bankers of this particular model. And now I'm not a banker, I'm an ex-banker. I have a lot more freedom to talk about this, I guess, I hope, pragmatically, and also to explore the joys of microfinance, or the not-so-joyous aspects of microfinance. SMEs I wanted to talk about particularly today, and the role potentially of Islamic finance in economic development. And the thoughts I'm going to share with you are not just mine, but they're the thoughts of several of the faculty at INSIEF who co-authored a book and published it a couple of months ago with the World Bank entitled Islamic Finance and Economic Development. And I commend that book to you, and that's the plug over. But I think I wanted to focus on the current structure within the conventional world of corporate finance, the trade-off between debt and equity, and particularly for small and medium enterprises, which are usually family-owned or fairly small. And that effectively these small firms, if they have access to finance at all, have to perform some kind of balancing act in getting the trade-off right between debt and equity. And basically, that trade-off is about, if you issue debt, you increase leverage, you increase volatility of returns, and there's a potential for risk shifting or for asset substitution. But if you issue new equity, and I apologize for the typo there, which I've just spotted, It's less risky than debt, but dilution of ownership may come about, and possibly, potentially, dilution of earnings as well. And also, it may give adverse signals to the market. So therefore, you're between a rock and a hard place on this, and getting the balance right is very often extremely difficult for these engines of the economy. And I think the World Bank will probably endorse that, in most countries, certainly developing countries, growth engines are usually centered around the SMEs. But if the SMEs can't get the financing, then the growth engine isn't going to work. And the SMEs actually are, surprise, the major employees of the less privileged members of society. So if I can move on in terms of looking at the capital structure with a risk-sharing environment, and my friend and colleague Humayun Dar was talking about this Musharaka type transaction this morning, so it fits with the continuity. That this is very much a risk-sharing type contract. It's one that the banks will probably shy away with and continue to shy away with from my personal experience. But the risk-sharing finance contract relative to issuance of debt does allow you, with those risk-sharing instruments, to provide returns based on the profits and losses of the investment. There's no fixed claim on the company's cash flow and no increase in the firm's break-even point. So the analysts, if the analysts are going to come into play, will be reasonably pleased with that. There will be an increase in the firm's financial leverage, but no increase in the risk, and returns are tied to the company's earnings. So it can act as a kind of inbuilt stabilizer. And looking at it from the perspective of equity, if the new shares are issued, these would rank hand in hand with the existing shares, thereby diluting ownership of all assets of the firm, which may be a problem for some. But with Musharaka Mudaraba, a sukuk type issuance, however, there would be a major, although a subtle difference here, that those sukuk holders have a right of claim only on the profits generated by the new asset or for the lifetime of the asset. So it actually is equity for a period of time, and then it's over and finished. So there's no ownership dilution, since the sukuks are specific to the new project being financed. So this could be an alternative to reliance on debt and a solution to the ever-present SME finance constraint. I was quite taken by the model that Tarek put forward this morning. I also think Humayun is onto something as well. And at this point, I think we need to get the brains together to actually take a look at, is this a viable solution? It's clearly been proven in the UK in terms of a non-interest related or no debt creation. And I think that this is a model that will probably work, but we need to actually work it through and try it out. This really is risk sharing, and the implications are, of course, reduced risk premiums. And this would give access to the market for SMEs to raise the financing. But I think that the challenge here is that the banks aren't going to get on side with this. So I would like to say in conclusion that the reality of making this work is that you've actually got to take it out of the banks, and you've got to create some other vehicle which is going to act as the financial intermediary that raises or manages or collates this type of financing. I recall again, in my first days in running an Islamic bank, that I likened what I had in my balance sheet was just really a Sharia-compliant conventional balance sheet. It was constrained by the systems and the regulations and everything that was around it. And I was trying to explain what I was looking to drive towards, although this was I was younger. I wasn't young then, but I was relatively young. I was younger than I am today. It was a young man's pipe dream that basically it was about asset and liability management. That actually the financing that I wanted to do was actually assets and liabilities as investments and then placing the investments. And as a result of placing investments, you needed to have expertise in certain marketplaces, that if you were working as an Islamic financial institution, let's call it that, as opposed to a bank, you needed to build up expertise in particular industries. So if you were going to lend green or you were going to lend to shipping or agriculture, you needed to have people on your team who really understood that business. And we certainly started to go in that direction at the first Islamic bank I worked for, and the second one, even more so, because we did focus on particular industry segments. But the challenge always was the risk position that the credit committee always took a look at. Well, you're taking a part share in this oil tanker or whatever it happened to be. What happens if this, this, and this? And they weren't looking at it as an investment. They were looking at it as purely as a risk transfer issue. And I think we have to get away from that. There is a need to work on not just the product model and the process model, but the operational model, both in terms of regulation and what type of companies would need to be in place in order to facilitate and make this happen. On that note, I think it's probably better for me to conclude, and we'll allow plenty of time for interaction and debate and discussion later. Thank you very much for your attention. Assalamu alaikum wa rahmatullahi wa barakatuh.
Thank you very much.